Okay, uh, what's up, everybody? This is Sunko, the Korean bro. Uh, uh, let's see. Uh, Pound stock will skyrocket, but only if this happens. What is it? Shares of Pound are dirt cheap as the company continues to struggle. If Pound can significantly improve its fundamentals, investors will be rewarded. There's a very slim chance the business can turn things around. Big investors can correctly assume that if a company experiences declining sales for an extended period of time, then there's a high probability that it will no longer exist at some point. As the economy grows, business should register increasing revenue. This is a clear sign that there is an interest from customers. Pound has struggled in this regard. Revenue in fiscal 2022 and fiscal 2023 dropped 10.9% and 21.8% respectively on a year-over-year basis. And in the last 6 months, revenue was down 5%. Management has made it a priority to get back to growth, but this will be extremely difficult when the business struggles to grow its subscriber base. I'm confident that if Paladin can return to healthy growth, the share price should appreciate. This isn't a bold statement. Anytime a company can turn things around for the better, investors will take notice. Want to get your portfolio to $1 million by retirement? Okay, let's see. Is up nearly 400% since the start of 2023. As it's such, it's become the bellwether for the AI boom. Its competitive advantages appear to be strengthening. So NVIDIA is an extraordinary demand for the GPUs, accelerators, and other chips that are well suited to run the kind of AI models that make programs like ChatGPT work, and Wall Street has had trouble keeping up with the surge in demand for NVIDIA's products. The chip titan has breezed past Wall Street estimate and typically gives guidance well ahead of the consensus. Wall Street estimates have steadily floated higher for NVIDIA in recent months. For the fourth quarter, analysts expect revenue to skyrocket 273% to $20.4 billion and see earnings per share jumping from $0.88 to $4.56. Those are lofty expectations, but they aren't unwarranted. In the third quarter, Nvidia's revenue soared by 206% to $18.1 billion. They forecast revenue of around $20 billion in the fourth quarter. So if you are buying a stock, it's best to plan to hold it for at least a year, which offers tax benefits and the advantage of smoothing out the volatility inherent in the stock market. As Benjamin Graham said, in the short run, the market is a voting machine, but in the long run, it's a weighing machine. It's easier to be right on the stock's weight than its popularity, uh, which helps gives an advantage to long-term investors. It's impossible to know for certain whether Nvidia will go up or down on its earnings report, but if you're buying stock, you should be buying because you believe it has sustainable competitive advantages that will enable it to continue to dominate the market for GPUs and chips. Use it as leverage to enter new markets such as PCs, which it recently announced plans to do. There's no shortage of euphoria for Nvidia or other stocks with AI exposure, and several small cap stocks recently skyrocketed when Nvidia revealed that it had taken small stakes in those companies. However, the recent surges from ARM and Supermicro indicate the market still seems to be underestimating the potential for AI hardware stocks like Nvidia. If I had to venture a guess, I'd say the stock is more likely to go up than down on the earnings report, and the options market is betting on that as well. Next Era Energy. Hmm. Wait, hold on. Let's see. Although the Oracle of Omaha and the team added more than 15.8 million shares to their existing position in energy giant Chevron during the fourth quarter, its historically cheap value stock, SiriusXM Holdings, that stole the show. After initiating a nearly 9.7 million share stake in SiriusXM during the third quarter, Buffett oversaw more than quadrupling on this position to 40.24 million shares in quarter four. In addition to loving wonderful companies at fair price, Warren Buffett tends to gravitate to businesses with untouchable moats and sustainable competitive advantages. That's precisely what satellite radio operator SiriusXM Holdings provides. Hmm. The Oracle of Omaha and its investing team more than quadrupled Berkshire Hathaway's stake in this historically cheap stock during the fourth quarter. Just in case you missed it, Wednesday, February 14th was arguably the most important day of the first quarter for investors. It marked the deadline for institutional investors with at least $100 million um, in assets under management to file Form 13F with the Securities and Exchange Commission. In simple terms, a 13F allows investors see what Wall Street's smartest and most successful money managers purchased and sold in the most recent quarter. In this sentence, I'm talking about buying and selling activity that would have occurred during the December ended quarter. So while there are dozens of top-tier asset managers known to draw interest in Wall Street, quite like Berkshire Hathaway, CEO Warren Buffett. Okay, since the Oracle of Omaha became CEO in the mid 1960s, Berkshire Hathaway's Class A shares have returned an aggregate of as of the closing bell on February 14, and practically doubled up the annualized total return, including dividends, of the S&P 500. Suffice it to say, professional and everyday investors eagerly await the lifting of Berkshire Hathaway's proverbial hood on a quarterly basis. What Berkshire Hathaway's recently released 13F revealed was, unfortunately, more of the same for Warren Buffett and his top investing ideas. Stickier for value, and Wall Street is historically pricey at the moment. Based on data backtested to 1870, the S&P 500 share price earnings ratio has surpassed 30 only 6 times. The Shiller P&E ratio examines the inflation-adjusted earnings over the previous 10 years. Okay, say hello to the value stock Buffett can't stop piling into. Gravitate to businesses with untouchable moats and sustain the competitive advantages. That's precisely what satellite radio operator Sirius XM Holdings provides. To begin with, it's the only licensed satellite radio operator. While it does still have competition for listeners will terrestrial and online radio, being the lone approved satellite radio provider affords the company exceptionally strong pricing power. The ability to increase subscription prices has helped it easily outpace the inflationary curve. quite differently than traditional radio companies. While terrestrial and online providers are heavily reliant on advertising to keep the lights on, Sirius XM generated less than 20% of its net sales in 2023 from advertising. Close to 77% of the company's revenue comes from aforementioned subscription to its service. Subscription revenue tends to be far more predictable than ad revenue. It's more likely to generate juicier margins. Additionally, a subscription driven model should help hold up better during economic downturns related to ad driven platforms. Can endure for multiple years, if not a decade. Although Sirius XM stock is susceptible to weakness during recessions, fewer vehicles sold means less chance of converting promotional subscription into self-paying accounts. It's going to disproportionately benefit from long-winded expansions. In short, investors who have time on their side are well positioned to succeed with stock like Sirius XM. So Sirius XM Holdings is the one that I have to look into because Buffett bought it. Probably it's a dominant player in its sector, so I should pay close attention to it. Okay, investors hoping to benefit as businesses invest in AI projects should buy and hold a basket of AI focused stocks. Cloud infrastructure specialist Amazon was recently recognized as a leader in cloud AI developer services. Okay. Amazon is a multifaceted business with compounding growth prospect in e-commerce, digital advertising, and cloud computing. It operates the most popular online marketplace in the world as measured by monthly visitors and continues to gain revenue share in North America and Western Europe. Moreover, while Alibaba currently leads market and growth sales, Morgan Stanley expects Amazon to displace the company by 2027. Building on that, Amazon's strength in retail has evolved to a booming advertising business. Its unparalleled ability to engage shoppers and source data helps media buyers reach consumers with relevant campaigns. As a result, Amazon has steadily gained share in digital ad spending for several years, becoming the third largest ad tech company. Even as the leaders, Alphabet and Meta platforms have lost ground. Analysts at Insider Intelligence expect similar results in the future. Finally, Amazon Web Services is a leader in cloud infrastructure and platform services. It's a 31% market share in the fourth quarter, easily topped Microsoft 24% market share and Alphabet's 11% market share. According to Synergy Research Group, the alone positions AWS as a probable beneficiary of AI, simply because cloud infrastructure is often the easiest way to run AI applications. However, consultancy Gartner has also recognized AWS as leader in artificial intelligence developer services, and the company recently bolstered its position in the market with Bedrock, a new service that helps developers build generative AI applications. Here's the bottom line: retail e-commerce sales are projected to increase at 8% annually through 2030, while the ad tech and cloud computing markets are forecasted to grow at 14% annually. It gives Amazon a good shot at double-digit sales growth through the end of the decade, but its bottom line should increase more quickly as its high-margin businesses account for more of total sales. And Wall Street expect earnings per share to grow at 30% annually over the next 5 years. In that context, Amazon's current valuation of 59 times earnings actually looks very reasonable. Patient investors should consider buying a small position in this stock today. Okay, let's access premium services and see what articles we have. Okay. Hmm. Tonight, overall, we have a bearish trend. Hmm. Okay, let's read about new one. Okay, Kinsale is the company name, and let's see what that is. Okay, Kinsale Capital keeps making money twice. Exceptional underwriting and favorable investing investment are paying dividends. Operating earnings jumped almost 50%. Combined ratio improved to 72.1%. Earnings per share increased 53%. Here's our initial take on Kinsale Capital Group's fourth quarter financial report. Okay. Okay, you know what? I'm getting a bit tired tonight. I better go to sleep early. Um, I'll come back tomorrow or the day after tomorrow, okay? See ya and have a good night, everybody. Bye bye.